In this presentation, we will take a look at substantive procedures related to long-term debt. You'll recall that the substantive procedures are the actual kind of in-process testing, the main thing we would probably think of for most accounts when we go through testing, actually going out to the office or to the client's office, oftentimes to the business, and looking through things like invoices or documentation within the audit process. Our process typically then being to consider inherent risk, to consider control risk, as we have done in prior presentations with relation to long-term debt, then consider the detection risk and how much substantive testing, what we're considering now, needs to be done. Also recall that with long-term debt, we often take the approach that we're going to do a lot of substantive testing, no matter what the results with regards to inherent risk and control risk are, because of the nature of the substantive testing and the nature of the accounts. So we're going to do a lot of these substantive testing. In other words, whether or not we assess the controls and inherent risks as high or low, typically, although we still want to get an idea of the inherent risk and control risk as part of our audit evidence, as part of our audit process. So we got the long-term debt substantive procedures. The auditor will examine new debt agreements. So any kind of new debt agreement we're going to be considering. Note here, of course, we're talking about long-term debt, and that means that we're thinking about debt that might have been on the books in prior time periods. And just like with property, plant, and equipment, we've already considered it to some degree. It's gone through an audit to some degree in prior time periods if this is a continuing client. And therefore, we need to consider, in essence, the main thing we need to consider are the new debts that are going to be on the books and any kind of changes that have happened during the current time period with relation to the agreements. The agreements themselves that are on the books from prior time periods are things that we would have audited in the prior period. Now, obviously, if this is a new engagement, then we're going to be more concerned with, we're going to have to go back to all the debt agreements and verify them in a more thorough type of fashion. So we have that same kind of activity between whether this is an engagement that's continuing, where we had the engagement last year and now we're doing it again, or if it's a new engagement, we'll probably have to do more substantive testing if we have a new engagement with relation to the long-term debt, with relation to that debt that was on the books last year and now is still on the books this year because it's a long-term debt. Determine the status of prior year debt agreements. So we're going to look at the status of the prior year agreements, confirm balances and other important information with outside parties. Analytical procedures are used because the direct relationship between interest expense and the amount of long-term debt. So we'll basically be considering these analytical procedures. Oftentimes, analytical procedures, then the ratios can be very helpful given this direct relationship. In other words, recall that the analytical procedures are going to be those ones that we can consider. I think of the auditor being nice and cozy in our auditing office instead of at the client's office doing analytical type of procedures, which is going to be like a ratio type of analysis type of procedures. Ratio analysis type of procedures are very useful, very helpful, applicable with regards to long-term debt because the interest related to it should be directly applicable, and therefore that type of analysis should give us really pretty reliable feedback. So now we're going to go through the assertions and the substantive procedures with relations to the test of transactions. So test of transactions, substantive procedures, long-term debt, and related procedures. So the first assertion is occurrence. With regard to occurrence, we're going to examine copies of new notes, new bonds, new financing lease agreements. We're going to examine board directors' minutes for approved new lending agreements. So we'll go through the minutes and we'll look through those, any kind of approval process with regards to the assertion of occurrence. And then we want to consider the completeness. And remember, with regards to occurrence, we're probably less concerned that there's going to be something that's on the books. Remember, occurrence means that it's on the books in essence, and we're going back to see that it actually occurred. And with a loan, we would expect that they wouldn't intentionally put something on the books that would make them look bad, like a liability on the books that didn't actually occur. So we will be going from occurrence, going back to the new notes, but we're probably most concerned with completeness here because it's more likely that if something was to happen intentionally to look better, it would be a completeness issue, not including something like a liability possibly on the books that should be included. So with regards to completeness then, we will trace significant cash receipts and payments to source documents and the general ledger. So we're going to look at significant receipts and payments, because if we go through the cash account and we see that we have a significant money that goes into the cash account, then if it's large or unusual, it might be due to a loan that happened. And that would be an indication that we want to make sure that that loan has actually been recorded, not only in terms of the deposit that happened, but also, of course, the liability that would be related to it, the loan. And that's going to help us to test for the completeness. If we see kind of standardized types of payments that are being paid going out, then we want to basically say, okay, now that possibly could be a loan payment, and we want to tie those loan payments to the loans that they're being paid off to, again, helping us to establish that the actual loan is indeed on the books. Review interest expense for payments to debt holders not listed on the debt schedules. So if we have if we go through the interest payments, we say, okay, there's interest expense. We see interest payments being made, things being charged to interest expense and interest payments. Therefore, we want to make sure that we can tie those interest payments out to the loans. If we see something that's saying interest payment and we cannot tie it out to a loan, then we're thinking, well, maybe there's a loan that should be on the books that's not, because we're clearly paying interest, and therefore there should be a loan related to the interest that we're paying. Next, we're going to review notes paid or renewed after the period end to determine if there are unrecorded liabilities at year end. So if we consider the transaction that's happening right after year end, our concern is, well, maybe is that transaction in the correct time period? In other words, are we complete as of the year-end time period here? And possibly these loans should be on the books at this point. So we'll test right after the things that happened closely after the year-end process and consider whether or not they should be in the current year. Then we'll evaluate lease contracts to determine if leases are correctly accounted for as an operating or capital lease. So you'll recall when we have leasing contracts, it can be that's one of the more complex issues with regards to long-term liabilities, because it's possible to format a contract in the format of a lease, but in substance it being in essence a purchase or a loan in some way, and therefore we need to determine that process and see if there's any items that should be recorded possibly as capital leases and therefore have the related long-term liability related to them on the books, as opposed to the operating lease where we would basically be expensing the leases as we go. So this is one of the more complex kind of issues that we would want to make sure to look into. Look at those lease agreements, consider whether or not they're going to be a capital lease or an operating lease. And if they're capital leases, do we have the recorded loans on the books? And that would be with regard to completeness. And then we have authorization. We're going to examine board minutes for evidence of procedural authorization of notes or bonds. So note, if we're talking about large amounts, oftentimes the notes or large loan amounts, bonds payable, notes payable, would go through the authorization process that would be set up by the company in terms of internal controls, which typically for large amounts would go to the board of directors and have to be in the board of directors and therefore in the minutes for the board of directors. Then we have the assertion of accuracy. Test a sample of receipts and payments for accuracy. So we're going to test a sample. We're going to go through and take a look at the receipts and the payments and test those for accuracy. Then we have the cutoff testing. That's the year-end testing. We could think of it if it's a normal 12/31 year-end, calendar year-end. It would be as of 12/31, December 31st being the cutoff. Review debt activity for just before and after year-end to determine if transactions are included in the correct period. So we're going to review transactions just before the year-end cutoff and just after the year-end cutoff and see if they're being recorded in the proper time period. And so we're going to think about things like payments that are being made as well as any new loan agreements. Now, of course, the loans you would consider aren't happening all year long. So normally there's not going to be a whole lot of new loans that would happen, and we can test and see when those new loans fall. If a new loan happens just before or just after the cutoff date, then we're going to be concerned with that. We're going to want to make sure that the loan was indeed put on the books in the proper cutoff, the proper time period. The other thing we're going to be concerned with, of course, is the interest payments that are going to be involved in the accrued interest. So those are the other types of things that we want to consider and make sure that the cutoff testing is done properly with relation to the payment of the interest. Next, we have the assertion of classification. And you'll recall with classification, our major concern is, do we have it properly broken out between short-term and long-term? That's one of the major issues we have. If we have a note, in other words, it's going to have multiple payments within the next time period, we need to break out the amount that's going to be due in the short term versus the amount that's going to be due in the long term and properly classify those items. We're going to trace contract dates and due dates on notes or bonds to these schedules, and analysis of classification between current and long-term debt. So typically we're going to get the subsidiary ledgers. We may need to get the notes, the contracts themselves, of course, look at the contracts, and then either generate or get the information generated for us with relation to the amortization schedules, which will show us the payments that will be made, when they will be made, and the breakout between interest and principal of them. Then we need to consider how much in the next 12-month time period will be principal portion, because the principal portion is the only thing that we're considering here, because the interest has not yet been incurred, and we'll have to consider, given that information, what will be the current portion versus the long-term portion, tie that out to the financial statements, make sure that they have been properly classified. Now, with a large publicly traded company, we would expect that they would be, and we just need to get these schedules, track them, tie them out to the financials, and it should all tie out, we would think. If you're thinking about a smaller type of company, then this might be an area where they might need help with to make sure that the amortization schedules are correct, that they have the proper classification between short-term and long-term. Then we have presentation, review disclosure checklist, and related disclosures for relevance and completeness. Next, substantive procedure test of details of account balances. So now we're considering the substantive procedures related to test of details of account balances with regards to long-term debt. First assertion, existence. Existence, we're going to confirm notes or bonds directly to the creditors with regards to existence. Then we have rights and obligations, the assertion of rights and obligations with regards to the account balance. Examine copies of the note, the bond, and the financing lease agreement. So remember that the existence and rights and obligation may not be the items that we're as concerned with, once again, because we would think that we wouldn't intentionally, or the company wouldn't intentionally put a liability on the books that doesn't exist, or that they don't have the rights and obligations to. And if they don't have the rights and obligations to them, you would think that in most cases they wouldn't be needing to record a liability which would make them look worse. So it could be an error of a process of existence or rights and obligations. We'll still do testing for them, but we're probably not as concerned with those assertions as with completeness. Completeness, if there was an attempt to have an intentional type of misstatement in order to look better, then you would think it would be with regards to completeness, having some type of liability that possibly isn't fully recorded on the books, which could actually make the books look better. That's probably where the auditor is going to be more concerned in most cases. With regards to the assertion of completeness, we're going to obtain calculations of notes and bonds payable and accrued interest. So we're going to consider what the calculations are with regards to them. We're going to foot the schedules and match the totals to the general ledger. So we want to get the detailed schedules, of course. We want to consider those calculations, especially with regards to accrued interest. So we want to consider the accrued interest types of calculation. These are items that we would think from a publicly traded company, they would have calculated out for us and have it all completed. And now, of course, we need to check and make sure that that is indeed done as it should be. If you want to consider what the accrued interest should be, that's going to be a type of adjusting entry. So you can think about the adjusting entry process to consider accrued interest and what that calculation would be. For a small type of company, then it might be something you would have to consider and help out with regards to the adjusting process for the loans. Obtain a bank confirmation requesting information on notes from the bank. So this is an area where we often will use the confirmation process. When we think about the banks, note that we always send a confirmation, or typically when we're doing cash, when we're auditing cash, we'll send a confirmation to the bank to audit the cash amount, because the cash is very liquid type of thing, and therefore we will do that. We will typically often also send a confirmation to the institution, to the bank, because that's the main institution you would think that the company would go to if they were to get a loan. Whoever they do their main checking account with probably would be the first thing that would come to mind if they need a loan. Therefore, we can ask that institution as well with a confirmation, are there any loans, or ask about loan type of activity. And that's one way we can think about completeness. We can go to the major institution they do business with and ask them as part of the audit if there's any kind of loan activity. And the thing is, if what we're looking for is to get loan activity on the books that hasn't been recorded, the third party confirmation, the bank possibly saying, yes, we have this loan outstanding that isn't on the books for the company. That's why it's testing for completeness. That does very rarely actually happens. In other words, we would expect any loans from the bank to be also recorded on the books, but that's what we're testing for completeness, to have a loan that's out with that institution that for some reason isn't recorded on the books. Confirm notes or bonds with the creditors, so we can consider the confirmation process with the creditors. Inquire of management about off-balance sheet activities. So if there's any kind of off-balance sheet activities where the liability isn't recorded, even if it's in compliance with generally accepted accounting principles, we want to consider what those are and make sure that they're properly disclosed, both in terms of financial statements and the footnotes. We want to review board meeting minutes for debt-related items. So any debt-related items, we're going to go through the board minutes, and as we consider these board minutes, you've seen them mentioned a few times. We're looking for some of those larger items, larger financing items, larger loans would be things that we would consider as well. If it was a large item, you would think it would be in the minutes in terms of the board meeting minutes. If it's in the minutes and we haven't seen any indication of it on the books, then that's another test we would have for completeness. Then we have the assertion of accuracy, valuation, and allocation. We're going to examine new debt agreements to make sure they were recorded at the correct value. So obviously any new debt agreement we have, we want to make sure it's on the books at the correct amount. Usually that's going to be fairly straightforward. If it's a straightforward note that we have, or if we financed equipment, that's pretty straightforward. If it's a bond, that's still fairly straightforward. If it's a more complex instrument doesn't have standard payments, or the interest rate fluctuates, then it could be a little bit more complex to figure. Confirm the outstanding balance for notes or bonds and the last date interest had been paid. So we want to consider what the outstanding balances are as, of course, the cutoff date, the end of the year. We want to consider when those last interest payments were going to be made, match them up to the payment process in terms of the amortization table. Recompute accrued interest. So the accrued interest is going to be something that we're going to be concerned with, of course, and that's going to be the interest that has accumulated that has not yet been paid. Different types of loans, different types of bonds will have different types of accrued interest, types of calculations. And remember that obviously the interest could be paid in whatever terms of the bond has, or whatever terms the note has. The interest will just be paid in accordance with the payment process. The accruing of the interest, however, will also be in accordance with the terms of the note, but it'll accrue at more of a fixed kind of process. So in other words, the accruing of the interest may not line up specifically with the payments. If you think about a normal type of note that gets paid monthly, then, or like a normal note that we might think of for like a mortgage type of process, or a normal kind of note payable, or for financing things, then you would think that we might have partial or part of a month that had not been paid, and we'd have to accrue the interest for that. If we're talking about bonds that are if the payments are being made semi-annually, then of course the payments are being made twice a year, but it may not land on the end of the year, and therefore, of course, we'll have to record the accrued interest. So again, if you want to think about the accrued interest journal entry, how we would test for that, you want to also think about what the adjusting entry would be. Go back to the adjusting entries process in financial accounting for accrued interest, and then we would basically be considering those types of calculations within the audit process. Verify calculations of amortizations of premiums or discounts. These, of course, relate to the bonds, which may be sold at either a premium or a discount. Those premiums or discounts should be amortized and written off to interest expense. They should be using the effective interest method unless it's basically an immaterial amount, and therefore we want to make sure that they are indeed writing those off in accordance with the effective interest method, in accordance with generally accepted accounting principles. Then we have the assertion of classification. We're going to obtain analysis of notes and bonds payable. We're going to foot the schedules and examine the due dates for correct classification between current and long-term debt. That's always kind of our thing with classification here. We got to make sure that they're on the books, but we also, the thing that's most confusing is usually that breakout between short and long-term debt. Match totals to the general ledger. Examine an analysis of lease liabilities for correct classification between financing and operating leases. That's the other thing that could be a problem depending on the type of company we're in. If we're in a type of company that has a lot of capital type leases, then, or any type of lease, we want to consider the leasings and make sure that they're properly classified, because there's a big difference between just writing off the lease expense and then having to capitalize the lease and record the related liability. And then we have presentation, assertion of presentation, review disclosure checklist and related disclosures for relevance and completeness, review loan contracts for restrictive loan covenants.